Congratulations, you have made it to the final module of Women in Finance. In Module 5, we will be discussing how you can actually start investing. And today, in Section 1 and 2, we are going to discuss the risks of investing and how to determine your risk profile. Risk is the probability of loss. And while investing in stocks is a great way to build wealth over time, there are risks that you need to know about. First up is market risk. The value of stocks can rise and fall based on a wide range of reasons, such as economic conditions, company performance, and global events. This means that even if you have carefully chosen your investments, you could still lose money if the market takes a downturn. Second is company-specific risk. Even if the market is performing well, your stock can still take a downturn based on the company's performance. Company-specific risks include management changes, legal issues, and product failures. Third is volatility risk. Stocks can be highly volatile, meaning that their prices can significantly go up and down within a short period of time. This is especially relevant for short-term investors who are looking to make a quick profit. Fourth is liquidity risk. Some stocks may be less liquid than others, which means that they would be hard to sell quickly if you needed to. This would pose a problem if you need to access your money in a hurry. Fifth is inflation risk. Inflation can erode the purchasing power of your money over time, which means that even if your stock is performing well, you could be losing money in real terms. Sixth on the list is interest rate risk. Changes in interest rates can impact the value of a stock in different ways. For example, if the interest rate rises, stocks can become less attractive to investors who can earn higher returns on other types of investments. Seventh is currency risk. If you invest in stocks that are denominated in a foreign currency, then changes in exchange rate could impact the value of your investment. And lastly, behavioral risk. It's important to be aware of the fact that our emotions and biases can impact our investment decisions. For example, you might be tempted to buy a stock while it's performing well and then sell it when its value goes down. That would actually mean that you're buying high and selling low, which is the opposite of the fundamental investment strategy. Now let's move on to Section 2, risk profiling. Your investment portfolio is determined by your risk profile. If you have the ability and the willingness to take on higher risk, then you should invest a higher percentage in riskier asset classes such as stocks. If you have a lower risk profile, then government bonds might be a better product for you. And that is why there can't be a standard investment strategy that applies to everyone. Everyone has their own risk profile and therefore has their own unique needs. Here are some factors that can help you determine your risk profile. Number 1 is understanding your financial goals. Understanding your financial goals will help you understand the amount of risk you need to take on to achieve them. For example, if you're taking on a higher return, then you might invest in an option which has a higher risk. The next factor that you can evaluate is the investment horizon. The investment horizon is how long you plan to hold onto your investment. Investors with long investment horizons may be willing to take on a higher risk, whereas those with shorter horizons may want to be more conservative. Younger people have a longer horizon and higher risk-taking ability. The next factor is actually risk tolerance. This actually depends on the investor's willingness to take on risk in pursuit of higher returns. Some investors may be more comfortable taking on risk, while others might be more risk-averse. Another important factor is actually your financial situation. An investor with a stable income, few financial obligations, and an emergency fund may be willing to take on a higher risk. However, an investor with significant financial obligations and less stable income might not be able to take on higher risk. The last factor is actually the experience and knowledge of the investor. Investors with more experience and knowledge might be willing to take on a higher risk. On the other hand, investors with less experience might choose more conservative options. All of these factors are essential when planning your asset allocation strategy, which is the plan on how you should invest your money. Remember that the best investment portfolio is a diversified one. So that concludes this lesson. Until the next one, happy investing.